It's the beginning of another month, the beginning of April, and we've made it through the first quarter of the year. Clearly, 2020 is going to go down as a year we'll never forget. Most of us have accepted this situation we're now in. We've adapted to a new normal. The bulk of the world is in lockdown, and we're treating this threat seriously. We've seen unprecedented government support that's going to benefit those most in need and help see us through these unprecedented periods. It's going to help bridge the gap, as the government says. We're also reminded how important family is, how important friends are, be it spending most of our days with them or keeping in touch with them virtually. Now, normally at the beginning of the month, in our weekly Property Insider chats that I have with Dr. Andrew Wilson, he shares his data, his statistics, his analysis of what's happened over the last month. And despite the turmoil in our property markets, that's exactly what I want to do again today. So welcome, Andrew.
Thank you, Michael. Yes, I think we can, without overstating it, feel a little bit more relaxed this week compared to last week, where obviously the unknowns far outweighed the knowns in terms of the economy, the housing market, and humanity in general in regard to the coronavirus.
Well, humanity's stepped up, hasn't it?
Yes. Well, it always does, Michael. Unfortunately, we're a hostage in the short term to all the nonsense and the doomsayers and the fools who want to get their 5 minutes or 5 seconds of attention. As we discussed last week, I think this will be resolved sooner rather than later.
Sure. In the meantime, the government's building bridges and it's come out with some very interesting, significant packages.
Well, that's right, Michael, and so they should. This is a government action that is unprecedented. Now, the government is taking responsibility for community health in a whole of nation process rather than, I guess, instructing us to take responsibility for our health. They're now doing that by these enforced quarantine processes. So given that they're directing and driving this particular car, they have a responsibility to minimise the negative outcomes that certainly will come as a result of these government policies, of this unprecedented government action and interference in our daily life.
Well, they're trying really hard to make sure, using your analogy of a car a minute ago, that it's topped up with fuel, it's all lubricated well, so that once we can start the car, once we can get out again, it's going to run properly rather than it be a rusty bucket when we get through the other end.
That's right. And look, I think that these are new times, new processes for everybody working from home, but humanity is adaptable and innovative. We're seeing that now, and perhaps out of it, I think we'll get two positives. The first will be a much more, I guess, a higher level of awareness of our personal health responsibilities and protocols. And secondly, that maybe there's a new workplace evolution will happen as a result of that. And I think at the end of the day, we may even become more productive.
Well, Andrew, normally at this time of the month, we talk about auction clearance rates, but clearly auction volumes have dropped as the market adjusts to these new policies banning on-site auctions. Now, last weekend was going to be one of the busiest weekends leading up to Easter. So you've provided us here with some charts. Tell us what's going on in the market.
Well, it was an extraordinary weekend last weekend, Michael. It was going to be one of the biggest weekends for auction activity, not just for this year, but for a number of years. Of course, the market had rebounded quite sharply last year. The momentum continued into this year. Sellers particularly were keen to engage the market, lots of buyers around. Competition was quite strong for property. Prices were rising. So it was a good time for those sellers that had sat on their hands last year to get back into the market. Of course, most buyers are sellers and sellers are buyers. So it was all a matter of that trading environment. So we did see lots of auctions scheduled for the pre-Easter period. Of course, we had these issues, not just of confidence with the shutdown of the workplace, but also the protocols you said, Michael, that were introduced regarding banning on-site auctions and restricting open for inspection. So this was always going to be a challenge for the Super Saturday environment. And we did see some remarkable but reasonably predictable, I guess, outcomes last weekend. We had nearly 1,000 auctions scheduled in Sydney, well over 1,000, nearly 1,500 scheduled in Melbourne. But the withdrawal numbers were just quite remarkable. We had 50% of auctions withdrawn that were scheduled in Sydney and over 50% in Melbourne. I guess we've got to have a little bit of an instruction, Michael, on how clearance rates are measured. Clearance rates take into account the withdrawal as part of the listed properties. When you do calculate clearance rates, you actually also include withdrawals, which I guess is a little counterintuitive, because if they're withdrawn, we really don't know what's happened. But so technically they're, I guess, counted in a sense as a passed in. And normally the number of withdrawals is quite minimal. Sydney has the highest proportion of properties withdrawn typically on a normal weekend, can be around about 5 to 7%. Melbourne has hardly any withdrawals. They're much more inclined to go to auction. So therefore it doesn't make a huge difference in terms of the clearance rate. But of course, with those massive withdrawals, Michael, they were counted as virtual passed-ins in the clearance rates on the weekend, and those clearance rates were at record low levels. But we have to understand that that was a product of all those withdrawals. And interestingly, I just did an exercise just to sort of reflect on those properties that we knew actually went to auction. We just looked at the properties that were sold versus the properties that were actually reported as passed in at auction. And we could see the clearance rates were a lot different. Once we understand the volume of withdrawals impacting those clearance rates, it was a lot better result. And it did show that there was still sales going on in the market. And that's my point eventually, Michael, is that yes, we suffer early days from confidence, but once we get used to a new environment of our social communication responsibilities and not being able to conduct auctions in the normal sense, we'll get back to the business of buying and selling, and that will happen, I think, sooner rather than later.
So clearly transactions are still occurring.
Yes.
There are discretionary buyers, discretionary sellers, and they're sticking back with. But there's people who sold their home who need to buy. There's people who bought a home who need to sell. And so the market is resilient, and estate agents are working differently now, Andrew.
Well, that's adaptability, isn't it, Michael? And that's what they have to do. It's their business. I mean, if there's no sales, there's no income. The market's not going to shut down, Michael. The market will move on. Because we're having a higher proportion of non-discretionary sales in the marketplace and there are fewer buyers, we will see downward pressure on prices. But again, that's a measurement issue rather than a reflection of the market.
Now, here we're showing your asking prices for the month of March 2020, and it shows a bit of a slippage in all the big capital cities.
Well, yes, Michael, I think that there was some volatility, and there always is in those month-to-month asking prices. There's seasonality there. But of course, look, these numbers are adjusted for compositional mix, but it was a very strong month, February. February, of course, was the beginning of the year. We came off January, so the month-to-month was always going to be higher. So there is obviously some impact from lower asking prices at the end of the month because of issues to do with the coronavirus and fewer properties coming into the market. But I think when we look at the year to year, that tells us more of a story. And we can see there that certainly Sydney's still well ahead of the pack.
What's going to happen to the rental market in these unusual circumstances, Andrew?
Rental data doesn't tend to be volatile in terms of its monthly movements, but the rental data showed Sydney's just starting to look like perhaps it's the last year where the rental vacancy rates have been higher and rents have been lower, as just starting easing slightly. House rents were up in Sydney over the month, but still down over the year. Unit rents are flat in Sydney despite vacancy rates rising there. But I think that shows some stabilisation, Michael, in the Sydney rental market. I do think that we'll see some upward movement in vacancy rates. And people will be looking at perhaps family or other options for renting. So we'll see lower levels of demand for rental properties. That'll mean higher vacancy rates and look, some downward pressure on rents, but I don't think it'll be substantial.
One of the things that has been concerning property investors, landlords, is are their tenants going to be able to pay the rent? But now there's the confusion about the moratorium on evictions and what does this mean for property investors? Fortunately, many business owners, employers are going to be able to retain their employees with the latest level of government grants. But this is one of the challenges at the moment. The government's coming up with great initiatives, but there's not a lot of detail behind them. The detail comes a while later.
In a way, the eviction policy is more about confidence rather than reflecting what will be a problem. As I said at the very beginning of this piece, Michael, governments have taken this action. It's unprecedented. They've decided that the government is responsible for our health now and that we have to work within government policies and take responsibility for everybody's health. So fair enough, if that's what they've decided, then they have to provide the support for the negative issues, the collateral damage that can rise as a result of that. And I guess I could finish by saying that One of the things that worked its way, obviously, into the sort of the fear of where this thing was going to end economically was the share market. We saw very strong, sharp declines in the All Ords in Australia, and of course the Dow Jones, spectacular falls, sort of falls we really haven't seen since the 87 crash, not at that level, but certainly moving towards that. And that was an economic shock, not due to these health issues. But we have seen share markets form a base now. I'm not saying they're going to bounce back quickly to where they were. The Dow particularly was overbought anyway and due for a correction, and many had been predicting that anyway. Not the All Ords, however, had been underperforming. And I think that's a good forward pointer to generally the rest of us getting on with the business of adapting to these new business conditions and work conditions.
Well, back to your car analogy from earlier on, let's keep the battery charged, let's keep the tank topped up, and let's hopefully we'll be able to go out for a drive really soon. In the meantime, we'll be back next week and have another chat, Andrew.
Yeah, Michael, and just remember, Australia has the best car of them all, so couldn't be in a better car.
Yes, you're right. Thanks, Andrew.